The author of the Big Picture blog and the founder of his own wealth management company, Barry Ritholtz, joins me on the line from New York today. Barry, thanks for being with us.
Hey, thanks for having me.
So Barry, I know you're one that speaks passionately about bubbles. So let's look at gold and bubble, since these are two words that people often use in the same sentence. If we look back at gold in April when it had that big correction, would you say that was gold's bubble bursting, or was that simply a necessary correction?
So I have a long history of gold, and I think a lot of people don't understand my relationship to the metal. So let me start out with a little background. So to begin with, I am asset class agnostic. I don't have a love or a hate for any special asset class. Truth be told, I tend to like equities because they've done so well over the very long haul. But I've been as negative on equities as I have on anything else. I got excoriated for the Dow 6,800 call back in 2007, but it turned out to be, not the worst call I've ever made. That said, we first got very constructive on gold. I want to say GLD was 43 or 46. It was a long time ago. You're onto something when you go on TV and you say, hey, here's a contrarian trade that I don't think most people understand. You could buy golds, and we had an upside target of either $12.50 or $13.50 back when it was under $500, and people look at you like you're crazy. The problem that I think a lot of gold traders ran into is that when conditions change, they didn't change the narrative. They stayed with the old story.
So stock market obviously healthy now. Barry, you recently wrote a piece on the possibility of the S&P hitting 2,300 by 2017. Would you suggest getting into U.S. equities right now?
That was a research report from Stephen Suttmeier, who's the technician at Merrill Lynch. And his analysis, which I have no idea if it's accurate or not, but I thought it was interesting, was what the technical traders call a measured move. When you have a market or a stock or a sector or a commodity that's range-bound, and it's been trading in the same zone for years and years and years, in this case, decade for equities, when it breaks out of that range, you figure out the bottom to the top of the previous range and then add it to that breakout, and that's how he calculated the 1576 was the breakout. The measured move takes you up to 2330, and the expectation is that's by 2017. I wouldn't necessarily agree with that, and I'll tell you simply why. Look, I hate when guys say the Dow will hit 100,000 in 50 years. That's a meaningless statement. But 2 or 3 years in the future, all right, that's close enough that we can, A, find out if it's accurate, and B, position ourselves ahead of it. If you go back and look at the previous breakouts, that like the one Suttmeier was referencing, you end up with a lot of false breakouts that subsequently collapse.
So, Barry, that leads to my next question. If I were to give you $10,000, how would you spend that in 2014? How would it be divided for you ideally?
So what I would do today would be a combination. So we're asset allocators, meaning we like to own a little bit of everything. I would be heavily underweight bonds, and the bonds I would have exposure to wouldn't be tips or treasuries because I'm not seeing a lot of inflation threats out there, but they would be corporate bonds, munis, and a little bit of high yield. And but a lower percentage than you would imagine in the typical 60-40 or 70-30 portfolio. We want to be underweight bonds because we think yields eventually go higher. So that's number one. Number two, we would own some percentage of U.S. equities, and I would guess somewhere between 30 and 40% of the portfolio would typically be look like that.
So Barry, what do you make of gold hovering around that 1240 mark?
The last time we came down in this area, I did an interview on Yahoo Finance and said, I think gold has become deeply oversold and is due for a bounce, and it wouldn't surprise me to see gold go to 1,400 or 1,500 before it rolls over. And the risk at that point of the rollover is that we could get down to 800 eventually. I don't think we're getting down to 800 anytime soon for a number of reasons. You have the replacement cost of gold, just the cost of mining. It puts a bit of a floor underneath it. But the question I ask all my friends who are super bullish on gold is, what is the next catalyst to move gold up? If you go back to when gold peaked in 2011, some 40 or 50% higher than this, we're just about 55%. The gold peaked 55% higher than where it is today. The catalyst was endless printing and QE and the devaluation of various currencies, especially the dollar. But here we are 3 years later, the dollar at relative highs compared to 3, 4, 5 years ago. QE infinity for as far as the eye can see. So you've had relentless printing, but gold has not used that as a catalyst. So I can't figure out what the next catalyst is for gold.
All right, Barry, that's all the time we have today. Thanks so much for being with us.
Oh, my pleasure. Thank you so much.
And thanks for watching this edition of Kitco News. You can email me at newsfeedback@kitco.com or follow me on Twitter @Daniela Camboni. Thanks for watching.